Hi, everyone. Thank you for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information here today without consulting a qualified financial professional. Well, we are thrilled today to bring you this educational presentation. A couple housekeeping items. Attendees are muted, but we do encourage you to ask questions using the chat box. And our presenter is happy to answer them during the webinar. So if something comes up and you have a question, go ahead and put that in the chat box and I'll try to ask that when it's appropriate. We will have a question and answer period at the end. We'll try to get to all of your questions, but if we're not able to get to your question, go ahead and leave your contact information in the chat box as well. We will make sure someone reaches out to you after today's event to address that. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I would love to introduce you to today's presenter. And let me go ahead and pull this up. I'm sorry, John, I lost my bio of you. Here we go. John O'Bannon is a financial advisor with Diversified Financial Group. Working closely with his clients and their CPA, attorney, and other professionals, John helps to design a prudent financial savings so you have more options when you retire, creating a strategy to pay for expected education expenses, and partnering with business owners and evaluating their business retirement plans and their transition strategies. This is what John does. John has enjoyed working with a variety of clients over the years. He has made the most impact with small business owners, women post-divorced or widowed, professionals, and executives at local companies throughout the Midwest and across the nation. And John, we're excited to have you here. And I'm going to go ahead and turn over the time to you.
Fantastic. Thank you so much for having me again. Welcome to those, whether it's in your morning or you're in the afternoon, we're glad to have you. Please feel free to stop me at any time with questions, as some of this might be really kind of close home to you, and you may have that question like, well, what does this really mean to me? That's typically, or someone going to be thinking the same question. So please feel free to do that. The biggest question is, what is a tax advantaged account? And quite honestly, that's very fancy words that a lot of people are like, as soon as you say the word tax, I'm gone. And I get that. Really, your money is in two different buckets in the eyes of the IRS. Either you have already paid tax on that money, or you are setting it aside and the tax is still due. It's one or the other, and 99% of the money out there. And when we get into, as a business owner, the two different kinds of accounts of either tax today or tax tomorrow, there's variations as you being the owner setting it up as how it will not only benefit the employees you may have, but certainly how it affects your business and even your own retirement. So we'll kind of cover up the hows and the whys for business owners as well, in case there are a number of you watching. So as we dive into the most common being employer sponsored accounts, which is a fancy way to encapsulate almost all plans that most people have, whether it's a 401k or a 403b or a 457 or many others, right? It's in the eyes of the IRS, it's a plan that has been set up as a benefit from the employer to the employees, that in almost all cases, your money and the employer's money is set aside for your benefit for some years down the road, and no taxes have been taken out whatsoever. And the benefit to that is not only, if there is a match, that free dollar, right, from the employer, but also the biggest benefit is that your money as the employee is allowed to grow 10, 15, 30 years with that tax dollar to your benefit. So your snowball stays its full size and actually continues to grow at a faster rate because that chunk was never taken out for taxes. That's the concept of the why behind it. And some folks might say, yeah, but I still owe taxes down the road. It's still, you're going to be money ahead, which is why it is a huge benefit. And it's actually a huge push by the US government to offer these plans to all employees to help you save for your retirement. The most common that we hear about or know about are 401k plans. From 30,000 feet, let's first state that the 401, or 403, or 457, they're all generically the same thing. What determines on a high level why you have one versus the other is not so much you, the employee, it's really what classification is your employer in the eyes of the IRS. If you're corporate America, or a typical self-employed person, it's going to be a 401k. If you're a non-for-profit or not-for-profit, it might be 403. If you are, a government agency, or some others are maybe a 457, a hospital, that kind of thing. Really, at the end of the day, you as the employee, it doesn't matter. It's relatively the same plan and how the structure is built. So don't get so hung up on those things. Really dive into the detail that does matter to you, as whether or not there is or there isn't a company match, which for everybody, this is the biggest thing that I will say as an advisor to you. It's free money to you. There's no investment in the universe that when you put $1 in, and if it's matched, you immediately doubled your money. So if you're not doing this, please do so. And traditionally, if it's a dollar for dollar match up to, let's say, 3% or up to 4%, most folks are not going to miss 3% or 4% of your paycheck, even if you're only making 30 or 40,000 a year. But if you were to take that, your 3%, their 3%, which means about 6, if you let that grow for the next 20 or 30 years, you will absolutely have a retirement that most people dream about. So don't get so hung up on what you have to put in order to get something. Look at what you're going to gain in the long run. It's almost untouchable. Your greatest asset, especially with retirement savings, is time. And if you can start this as a 20-year-old or a 30-year-old, no day is too soon, okay? If you can only start this at 50, great. Just get after it. You will have contribution limits. Typically, again, it's whatever that match is. Not all employers have the ability right away when maybe they're a new organization or they're just setting it up. Maybe they won't have the ability to add match right away. Or you're a new employee and they don't match your money for first 3 months or first 6 months. It's still worth it to put your dollars in and then eventually get that match. Because again, every day that it's growing is a day that's to your benefit.
I have
How those matches are specifically in percent is determined 100% by each individual 401k plan and therefore each individual employer. So when you change employers and so on, be aware of those details. And if you need, ask an advisor, they'll help you do that math for you. All contributions are going to be pre-tax, meaning, again, no tax has been taken out by either you or, of course, the employer, right? They're never going to pay your taxes for you, which is fine. You still get the free money. But that does mean that some point down the road, when you go to use those dollars, 59 and a half, 70, 85, you will be taxed then at your income rate. Now, so we were like, well, why would I do that? Down the road, I'm still gonna have to pay the taxes. The idea behind that is that today, when you are earning your money, let's say that your tax bracket is 30%, 35%. And if you were to pull dollars out, you pay 35% today in your paycheck. Well, the idea is when you are 60 or 70, you're not going to have that regular income stream. And so your tax bracket's going to be substantially less. Let's just say it's at 15%. Well, if your money was allowed to grow for 40 years, and when you actually go to take it out, you're paying less tax, you've compounded not only the growth of those dollars over the time, but you've actually cut the amount of tax that will be due. So it's kind of on the front end and on the back end why 401k or retirement plans are so strongly encouraged. And that's why they're so prevalent. And that's also why when you're changing jobs, certainly should be a benefit that you look for, you demand. Another similar version of this is a 403b.
Before we move on to that,
sorry, go
we
ahead.
did have a question here I wanted to get in here.
Yeah.
Can you talk a little about when is the earliest time you can withdraw from your 401k?
Sure. Unless there are it's about 7 specific circumstances, right? Death, divorce, major life-changing events that are all very much to the negative. If it's just a normal everyday withdrawal, 59 and a half is a very specific date for your 401k plan. When we get into Roth and so on, there are other things like if you want to use the Roth for education, you can do that. We'll cover that later. But just as a general purpose, I want to start pulling my funds out. It's 59 and a half. Another caveat to that is it's not forever stuck in the 401k plan. Let's say you continue to work until you are 65, which a lot of folks do. There is a thing called in-service withdrawal. And what that means is you can take a certain percent of your 401k plan investments that you have, and you can move it to an outside IRA that you have, just because you want to manage your own money, whether it's because you have different investment options or you just have a different plan going on outside of your work, all kinds of good reasons to do that. But know that you don't have to be taking the money out to spend it at 59 and a half. There are other ways when you're thinking broadly of investment planning, different ways to move your money around that doesn't have a negative effect on your or impact on your taxes.
All
That
right.
answers the question, hopefully.
I think that addressed it. We did have
Good.
one follow-up question here. So at 59 and a half, when you withdraw, is it penalized? Can you talk a little bit about penalties?
Sure. Great question. So after 59 and a half, the penalty is really early withdrawal penalty. So before 59 and a half, there will be an additional penalty. So you can take your money, but quite honestly, when you take the money, you still have to pay the tax at whatever your current tax bracket is, and then they add another 10% of a penalty. So by the time that, let's say you're at 48 and you want to pull the money, you've essentially eaten up almost any growth of dollar that you would have gotten on whatever that amount is that you're pulling, 5 grand, 10 grand, 20 grand, whatever that is. So whatever that growth would have been in those 20 years, because of all the taxes and then the penalty, you've kind of nullified that. So really there's not a lot of benefit unless, again, your life is a dramatic change and you have to use the dollars, then do so. But if you can wait to 59 and a half, there's no additional penalty. It's only that you'll have to pay taxes at whatever bracket you're at.
All right, we'll go ahead and move on to the next
Great.
slide here.
Beyond that, there's so the 450, excuse me, the 403B. Again, this is more specific because you either work for the state as a, some have 403Bs that are teachers, and we'll talk about something else for teachers later. But also maybe you just work for the federal government or the state, all of which have a 403B or a nonprofit. And again, this is specific because the IRS sees those employers differently. A lot of the overall contribution limits and how it's structured is very same. The one big difference is that there are certain employers that offer the 403B that also within that specific plan allow for an additional 401k contribution. It's not by everybody. It's specifically for those employers that say, you know what, we still want to offer a little bit more tax sheltered saving for our employees. So we're going to add a second plan with its own rules, because some people have shown interest to save more, which is great. It's a great benefit to have. And again, in both situations, it's just still dollars that are non-taxed and will be in both situations, right, when you pull those dollars out. The next type of plans are 457, if we're just going by numbers. And again, that's offered by whether it's state governments or churches, nonprofits. Again, it's very similar to the previous two. It's your employer is required to offer whatever number plan, 401, 403, or 457. Has nothing to do with you and your money. The type of investments that are offered for you to invest in are all very similar as well, both in whether they automatically enroll you or you are automatically put into a certain type of investment, whether that's one that is a timeline based, like say you're going to retire in 2040 or 2030, or if they're going to allow you individual assets, usually a lineup of mutual funds or what's called ETFs, very similar assets, just how they work is different. But in all three of these plans, what you have to choose as the employee is very, very similar. And it's all meant to be pretty foolproof and try to encourage 80-90% of employees to automatically take advantage of this investment growth that has been proven by the government and the industry, if invested 20, 30, 40 years, makes a dramatic difference to your retirement and ability to retire. So to back up a second, that there's usually if you only see one fund for all of your money, it's not necessarily a bad thing. It usually means you are in a fund that is based on either your risk tolerance or a fund that is based on like a timeline, that 2030, 2050, 2060 end time. And so if you're on a date reliant asset, it typically means that those that are further out, 2060, 2040, whatever, the closer you get to today, the more conservative they're going to be. The further away, the more growth orientated it's going to be. And likewise, typically, the more volatile. If you want to, and if that's the option that you have and you don't have another option, if you say, but I'm typically more aggressive, or I personally don't mind my month over month balances kind of having fluctuation because I'm here for the long run, then you can change that however you want at any time. You may retire in 2030, but you may set your assets like, I want the 2060 just because I want to have more growth. Conversely, on the other type of an investment where you're kind of a middle of the road investor, what's that really mean? You ask 100 people, you're really going to get 100 different answers. So you dive a little bit deeper into that conversation and you say, usually to yourself, do I mind a little bit of a fluctuation every quarter in my account? That's probably a better question to ask yourself. And you're like, no, I just don't ever want to lose anything. Okay, you're going to be a little bit more to the conservative side. The funds work very similar, whether it's time-based or how you feel about money. The main difference is the ones that are risk tolerance based will stay that way until you change them. So if you retire in 10 years or 4 years or 40, that blend that you have of aggressive or conservative is going to stay that blend. Whereas the time 2040, 2050, as you get closer to those dates, the fund manager that is watching your investments on your behalf is naturally changing that mix to be more conservative the closer that you get to those dates. That's the biggest difference between the two. And it's just something for you to understand as an investor from a very top level. Okay.
I do have
Go
a
ahead.
couple questions
Yep.
here that I wanted to get in before
Yeah,
we got
absolutely.
into more types of accounts.
Yeah.
So there was a question about what you said about penalties for 401k or any kind of retirement vehicle that has that is tax deferred. So in what situations are you not penalized for withdrawing? So for example, what would happen in a divorce?
Okay, so there are again, it's 7 specific instances, and it's on the IRS website. And I often will send folks, so it's irs.gov, and it will lay it out very specifically. But again, even within your retirement account documents, you have the same listed. So specifically in a divorce, you are allowed to split those assets as the court requires. It has to be done with a decree through the court. It can't be just that you're getting a divorce and you want to do certain things. There actually has to be the legal document that states percent or assets or what have you. Your retirement plan provider will ask for that document specifically, mainly because, again, there is liability of when the court says X, they execute X. They have no way to create any sort of gray area. So if you're going through that unfortunate situation, make sure you have that document. And then it's really straightforward. It's just divide, and typically the two spouses, now X, obviously the new account will be created for the spouse that's not working at the employer, and they will have to create an account for that within the 401, and then they can move those dollars out, whether it's into their own IRA or their existing 401k at their employer, but they can do whatever they want with their money. And then you can continue as the remaining employee, just to continue to build on your account as you did before. So then the other, again, as I mentioned, it's going to be a death in the family. It's going to be, of course, you move jobs. So then your options for your 401k, you can leave it there. You can roll it to the new 401k. You can roll it to an IRA, which on a very high level, all of these are an IRA, which is an investment retirement account. This industry loves its jargon like any other, but to simplify, it is the most vanilla way of saying retirement account, which all of these numbered accounts are. So what you're doing is you're just taking it from the specific and you're throwing it into a broader type of account, which actually allows you to have all kinds of different investment options and styles. And typically that's where you'll work with an advisor to make it customized for you. I'm trying to remember the ones that had, but that said, is really, it's the major life. You can have a first time home buyer. You can, a major health event is typically also a reason to pull IRA money without having any sort of penalty by the government.
And so that would be specific to those IRS regulations.
That's
You have
right.
to be really careful about that so
Yep.
you avoid a penalty.
Yeah. Oh, and the last option, sorry, when you leave a job, and you may know this, your fourth option, right, besides leave it, roll it, transfer it, if you've only got $1,000 in an IRA, or excuse me, a 401k plan, and it's a lot of hassle, sometimes you can just pay it out, pay your penalty, take your cash and move on. You can do that. It's an option. It's one of the four. So I wanted to be clear on that.
So to the participant who asked that question, please let me know if we've answered that, or if you need any more information. We're happy to address that. We did have another question about self-employed retirement plans. We're getting to that.
Yeah, no, that's great.
We're not quite there yet.
You're leading us right to it. Love it.
We do need to cover this one as well.
Yes. So this one, I get a lot of folks asking about the TIAA, which is the Teachers Insurance Annuity Association, which is different than TIAA-CREF. CREF is the major provider or holder of these types of accounts. But as you can see down below, there's all kinds of different types of accounts that are provided by these organizations of, again, where you might be working for a hospital or the government. It could be for military. All kinds of different things may offer. This is very similar to 401k. It's just a different way of doing it, different rules. And again, within TIA has kind of its own bucket of ways to save, and you can have an annuity in there and have an IRA in there. You could have, all these different funds. It's just a very, very similar way, but again, it's all about the type of employer you have. And if you have TIAA-CREF as it says, the traditional plan provider, if you leave that organization for different employment, TIAA-CREF does a very good job of showing you the benefit of leaving the monies there while you then go on with other things. And maybe it's because, well, if you come back into the teacher industry, you can keep adding to it and so on. There are some good things there, but there are also a lot of really good reasons to evaluate the costs that are associated, as well as the return that you get. And it's absolutely something that an advisor can dig under the hood for you on your behalf. And quite often it's worth that effort. There's a couple of forms typically to go through, as TIAA Craft is really specific with their paperwork. But it's great for you to have the most clear point of view.
So if
so
someone
then-
has, so if
Go ahead.
someone has that type of account and
Yes.
they want to talk to an advisor about understanding it,
Yeah.
is that something appropriate, even if they don't intend to do anything more than just,
Absolutely.
what is this about?
Yeah, absolutely. Actually, in all of these, right? So even if you have a 401k, and let's just say, the plan provider is John Hancock, or it's Mass Mutual, or whomever, right, is offering it, and you've never actually talked to someone at those organizations, it's fantastic just to bring in an advisor and say, well, what is this? Mainly because I can talk to you, I can see you, and you're in my town. You may not be able to do anything about it, but the understanding of what this really is, what the fees are, and does it really the best thing for you long term, or how do you build maybe around it to add? Absolutely worth that.
And so that's a conversation you can have with an advisor about any type of retirement account you have.
And 99% of the time it's free. It's literally just bring in your statement, and they can do the research behind it. Yep, it's very that broad, very simple.
All right,
But then
well,
leading to your point, right? So for the self-employed and or the small business owner, there really are a lot of options for you, whether you're the sole employee or the sole owner, or you're just the owner and then now you're going to take on employees, as we've seen in the last couple of years. The great resignation, whether it's by your choice or not, we've had a lot of folks changing, and we've had a ton of new businesses created, which is super exciting, which leads immediately to a huge need here for the self-employed and or the small business owner, who now maybe you've grown and your cash flow is now such that you're bringing on employees, and this is something that they're asking for. It's not so much a detriment to you as the company, like, oh no, it's another cost. It can actually help on the backside with your taxes as well, because obviously contributions made on your behalf, are a tax write-off. So, and actually some costs of setting up the plan may also be a tax write-off, as well as if you're setting up a 401k or so on. There's actually been in the last 3 years, the US government, in its effort to incentivize employers to set these plans up, they are giving tax credits and sometimes rebates to set up the plan so that your cost is completely offset. So it really becomes, for those that are thinking about it, absolutely raise your hand and ask the questions, because it might be much, much, much easier than you think. So typically, the first ones are either a solo 401k or a SEP, as they call it. And we'll go with the solo 401k first. Really, you are setting yourself as a one-person organization, and you are the employee. And the solo 401k allows you to make contributions and match your own contributions to yourself. So it's, if you can think of a 401k plan and all the benefits that go with it, but you're the only person. That's the reason for it. Again, it's all pre-tax dollars that are used, and of course everything coming out. So it's very similar to how 401k runs. It's just you're one person doing it all.
And I just want to clarify, it looks like on this slide, we may have a little bit of an error here. Is it just for educators and nonprofit employees?
No.
It's for anything. So our apologies there. We will fix that in the recording, but I just had also a question on this slide here. So when it says may include a company match, if you're self-employed, what does that mean?
Well, just like a regular 401k, when you set up the documents for the plan itself to create the structure, the match amount is predetermined, and the US government has a cap on that of percent, again, 3%. Whatever it is that you want to put in those plan documents then becomes your match ability. If you want to, if you're an employer, if you are a self owner and you want to set this up, or you're a small business, and let's say you have great cash flow and you have the ability that you really want to save for yourself, and then by and large also let that trickle down to employees, there's also additional components that can be added to 401k plans called, well, of course, there's profit sharing, but then there's also a thing called cash balance and some of defined benefit programs that you can get into. So if you're that employer that is either one person or you're a small organization, but you really want to maximize your savings, and let's say you're above 50 and you really want to, double down on your saving efforts, there are certainly, I think of them as kind of like add-ons to 401k plans that allow you to dramatically increase the amounts that you can save. And it has pretty substantial effects to your tax liability at the end of the year. Some of those get pretty complex, so we won't dive into them, but absolutely know that they're out there. And so then if you go to the next one's the solo defined benefit. Again, this is kind of what I was leading into. Let's see, self-employed. Oh, this is the SEP.
Yep, sorry.
That was
We're
my bad.
skipping over
Yes.
here. Yeah, no
So
problem.
the SEP are essentially it's a retirement plan that the employer will make contributions to, but the employees all have individual accounts. And those employees can choose, if they so desire, for those accounts to be at wherever they want. If you have Schwab or Edward Jones or an individual advisor, you can have your account there, and then the employer will send those contributions from your paycheck as well as a match to wherever it may go. The advantage there is that either the employer may have that desire to have a little bit more control on your investment growth and how it works, as well as it's cheaper to set up a SEP than it is a 401k, especially for a smaller organization. That makes sense. There are limits as to how big a SEP plan can be before it goes to a 401k and the number of employees that it takes, but they're usually right out of the gate the cheapest way, and they're easy to maintain as long as the employer kind of designates one person, like you make sure you take care of all the contributions and they're going to the right place. And if employees come and go, if they don't all sit with American funds, for example, as the fund company that does the investing, then you have to manage wherever the contributions go. So there's positives and negatives to all plans, and each employer goes through that process. If you're the employee and you have these different kinds of plans and you're part of them, really at the end of the day, they're very similar to you and how your money acts. How you can have an impact on them as the employee is the blend of the investments that you choose, and how much you put into it. And that's from the employee's perspective. From the employer, there's a little bit of sorting of the overall goal of the organization. that needs to be determined as to what's going to be the best fit long term. Okay.
So
again,
as a
go ahead.
clarification, so setting up a SEP IRA, if you're self-employed and have a business, and are you required to have employees to set up a SEP?
Good question. So no, you are not. That's one of those things that this is something that you can do, again, as a individual owner, and you can save for yourself. Good question. So then this is the solo defined benefit. And this is really kind of the next level of saving for organizations that have good cash flow, and they want to really maximize not only their ability to save, but also some of their tax benefit on the backside with contributions. Without getting really into the weeds here, I may have already, I apologize, but it's absolutely something that you'll see a lot of professional offices, whether it's, as it says here, doctor's office or a dental office, or sometimes accountants, or even just small, I've seen small construction companies use these where, again, the number of employees that will be there long term and they make good salaries isn't the whole workforce, and maybe part of the workforce is seasonal and so on. So this allows the employer to have an additional benefit for those folks that are going to be there all year and long term. Maybe it's highly compensated employees. And so you can have these different options as an employer to, again, help retain really, really good people. It's not just for the employer or owner, but certainly benefits them as well. As I kind of mentioned, all of this is under the vast umbrella of a traditional IRA once you leave your employer. And all of these are investment retirement accounts. The numbers purely just speak to where the IRS puts your employer in its tax code. When you leave, or on the side, if you want to do additional savings, you're going to open up a traditional IRA. So for the next slide, and it's really for your own use and for your own control. Contribution limits, holistically for a year, the current, it just changed for 2022, each individual in all retirement savings is $20,500. As we'll talk about a little bit later, if you put into a Roth, that currently is $6,000. And if you are 50 or older, you can have what's called a catch-up contribution of $7,000 per person. Now, if you are married, filing joint, you can have one income and still put away the $12,000 or the $14,000 right into your Roths, depending upon your age. So it doesn't take two incomes in order for you to save for both people. And the 20,500 number includes the Roth and any contributions that you would be making through your employer sponsored plan. Okay, so that's like the max really for anybody. And the reason why they do that is because typically, if you're able to put 20,000 away in any one year, the US government says, okay, now you should be, you don't need the tax advantage anymore. You need to now invest in different ways. We're not just going to allow you to put away $500,000, right? So they cap that so that the average everyday person of America can make a substantial investment in their retirement and be ahead and have the same kind of advantage that millionaires have, in that you can save the same amount, right, to that cap. There is kind of getting into weeds a little bit as your income rises, whether it's filing as a single person or filing joint. There are stages of income that you lose how much that cap is. So you can't put away as much. So as an individual, that you start stepping down from that 20,000 a year at 68,000 to 78,000 of income. Okay. And you're like, well, how would you do that? Well, if someone wanted to give you that and you wanted to, invest the whole, let's say they gave you 40 grand, right? Well, if you make 80,000, they're not going to allow you to invest it all in any one calendar year. Maybe you have to wait to the next calendar year. There's ways to get creative in doing this. Just know, in 30,000 foot way of thinking of things, as you make more money, you might have certain caps or steps by the government as to how much you can actually put away, which then brings in the creativity of, right, the other things of profit sharing and cash balance. And that's why those are there. Okay.
So I want to just let you know, we have several questions,
Yeah.
but I want to get through the Roth IRAs because there's
Yes.
several questions
And we'll come
about
back.
that.
Great.
But then if we can pause for a minute and answer some of these questions that have come up, that'd be great.
You bet. You bet. So we'll go right into the Roth. So in all of this that we've talked about so far, everything is pre-tax, meaning it all comes from your paycheck before any taxes are taken. The Roth is, it's been around for a couple of decades, but it's really gained speed in the last 20 years because the greatest value to this is that while everything else, 401k and the rest of the traditional IRA, as it grows, all of that growth is taxable. The Roth, you put the money in after you've paid the tax. So typically it's going to come from your savings account or whatever fund that you have that you've already paid the taxes on, and you make that contribution. The greatest thing is that then for the next 20 years, 30 years, whatever years, all of that growth is 100% tax-free. So you are creating a bucket that when you're 70, you have the choice of, well, can I pull from my IRA, which was sitting there for 40 years and it's $300,000, but $1 is taxable. Or I have a Roth and maybe it's only 50,000, right? And that's okay because that 50,000, the US government doesn't care when you take the money out. That's literally like a savings account. You can take it, use it, do what you need, as long as you're beyond 59 and a half. Or you can say, well, I can take out, in a tax conversation with my guy, he says, I can take out 10 grand from my IRA, pay tax, and I can take another 10 grand from my Roth. And now you've literally, right, cut your tax in half and what's owed. But what's really cool about the conversation, when you start taking money out in retirement, and let's say that you're really close to a tax break or tax bracket, you don't want to take a huge hit of 20,000 for a down payment of a house or a vacation or whatever that might be, and really pay a huge number in April. So what you might do is you might take, well, I'm going to take that smaller half of that amount, let's call it 10 grand out, and I'm going to take the remainder out of the Roth. And now I stay at a lower tax bracket in the following April. And I've really maximized all of the things that I have going on. So that tax-free growth is amazing, which is also why the US government says, we're only going to allow you to do 6 grand a year. Otherwise, every millionaire in the world's like, yeah, I'm going to put all my money into a Roth, right? Because everyone wants tax-free growth. But again, it's the US government's way of saying, we still want to provide you really smart and sound ways to save your money, but we still have to operate. We still need taxes, right? So that is typically the number 2 bucket that I will tell folks. Once you max your match from your employer, 3%, whatever it takes to get all of their free money, the next dollar of yours should go into a Roth. Some people are like, well, I want to put 10% into, the 401k because it's easy. I understand that, but that difference of, let's say the match is up to 3, that next 7%, the only benefit is that it's growing, right? And that's great, but it's growing with tax. If you were to take that 7% now to put it into your own Roth, now that 7% is going to grow tax-free. So you're using, at that point, the tax advantage smartly. And if you have that ability to max out both of those buckets of 6, 7, 8 grand a year, that's a fantastic place to be. And probably after that, your next step is kind of the next evolution of investing for you. And it just gets, more options as you do that. So I won't get into all of those things, but a Roth really is a huge advantage. I will say the only caveat to your Roth limit of 6 grand a year is if it is within your employer sponsored plan, your 401k or the like. Oftentimes they will say you can have a traditional IRA contribution or you can have a Roth. Okay, depending on how old you are and how much money you're putting into that 401k is whether or not it's best for you to have contributions in both. So that's the structure of a 401k and the rest 403b and the like have changed in the last 5 years so that the employer can again add that as an added benefit, mainly because employees are demanding more and we need more options as we plan for our retirements. So try not to get tripped up of, yes, there's a Roth inside the 401k and what's that do? It's really the same. It's just now you have another added level. Now, know one last thing, that your contributions are the only things that are going to go into a 401k Roth bucket, right? Because again, the taxes have to be paid before it goes in. Again, I have yet to find an employer that wants to pay your taxes for you. So your money is going to go into the traditional. And if or when you leave, you're going to leave with 2 accounts, that Roth account and that traditional account. Not a big deal. It just means, just be aware that you've got 2 different types of tax being used within the same vehicle. Hopefully that helps.
So the question is, when people sign up for a Roth 401k, that's where those 2 are split, to the tax-free part and then the part that's going to be taxed on withdrawal, which is the contribution from the employer. Is that correct?
Yes. So again, it's all about the growth and the tax-free conversation, right? The best way is to back it up to say, when contributions are made, Roth, you have to pay the taxes before it goes in. Traditional, the taxes are not taken.
Okay.
On the backside, as it grows, Roth is tax-free growth. Traditional, always taxed.
So here are some of the questions we have about Roths, and I know we're coming up against our time here, but if
I'll make it short, I promise.
I would just say to our participants, we will be sending out a recording of this webinar. So if you have to, go and you can't stay, but we'll stay a little bit longer just so that we can make sure to answer these questions as much as we can. So if you are a 1099 contractor, can you get a match?
That is wholly dependent upon your 401k. Typically not.
So if you have like a
Typically you
solo,
Yeah.
if you have a solo 401k that you've set up.
And again,
Because-
that's to the legal documents when you set that up. You're going to have to, when you're talking to your provider for the retirement plan, you will go through those processes and be specific about that.
Okay, so it's dependent on your
Your situation.
Yeah. So if you have adult children that are starting to work, let's say they're in their early 20s, what are the pros and cons of having them to contribute annually, monthly to a retirement account, say like for a Roth?
Sure. The original statement of your greatest asset is time. If you can get a youth 18, 20, 25 to start contributing, they can. So statistically, they've done the math that if you were to start when you're 18 and quit when you were 30, and then you don't do any more contributions until you're 40, you will still be financially ahead when you retire than as if you started when you were 30 and you actually double those contributions going forward. And that's only because you are now using the ability of compounding that growth over time. So if you can get a young person to contribute, it's easy for them. Oftentimes, our kids don't really know the true value of $100, for example, right? So for them to get $97 because they put 3% away, never going to notice, never going to miss, but you're giving them the better habits that for the next 40 years, they will absolutely keep, and they don't have to, quote, learn them. And that is arguably one of the best benefits you can do for your kids.
So would you recommend maybe to this hypothetical family, like monthly or annually to contribute? So
monthly, quarterly, weekly, whatever that is, the shorter the time, usually the better. And the reason why is you're taking out the guesswork of the movement of the markets. And it's called dollar cost averaging. You will be much further ahead if you are consistent with your contributions and the market's going up and going down and going up. It will average to be cheaper when you're buying over time because you're constantly catching the ups and the downs rather than one time a year or even one time a quarter. You could be up, you could be down, but you're setting a larger chunk of money at whatever that rate is. And if you do it over time in smaller pieces, the average will always be a smaller number. So if you could go monthly, I would do monthly.
All right, we have a couple more types of accounts to cover, and then I don't know if we have very much time for questions, but if you
That's
get
great.
your questions
I can go quickly. This is more, the next two are really more tax advantaged or just tax in general versus for your kids. And there's a big push to understand a 529 plan. And then it's comparative account for youth is a custodial. And so usually the immediate conversation is one or the other. And so the 529 is 100% for education. It could be for that child. And if that child, let's say they don't go to a higher level education, or they don't, it can also be used for private education. Now the laws just changed. It can be also be given to a family member including the adult that started it, but it has to be connected with a family. And the main limitation really is education, period. There is per state a different amount of how much your tax benefit is when you make that contribution on behalf of the child to the 529 plan, what that dollar amount limit is. In Iowa, give or take about 3,000. And then you lose your tax benefit. So some folks, unless you're going to put in that max 3,000 every year, the offsetting tax benefit may not be as wonderful for you to consider when that kid may not use it for education. If you're saying, I just still want to save money and I want them to have the flexibility, then you're going to go to a custodial account that you don't get that tax benefit for when you make the contribution. But in both cases, when the youth becomes of age in your state, that asset becomes their asset. With a custodial account, they can do with it whatever they want. As most parents know, that's good or bad, depending upon your kid. But it's awfully hard to know what that kid's going to be when they're 4. So this is it's a challenging conversation, and kind of in your gut, you have to make that direction when they're young like that. And whether or not, as an adult and a parent, you want them to have the flexibility to put a down payment on a house down the road, or if you want to just, pay off bills maybe after college is done versus paying it on the front end with a 529. A way for both of these accounts to be an advantage is that they allow for multiple sources of donations. So grandma can give money to either of these accounts just as well as mom and dad, or some sort of beneficiary can give monies to these, and everybody's money is added to the same snowball and it all grows together. And it's easy to say to others that may want to give to the child, hey, I'm not controlling this money. I can't touch either of these monies as the custodian, as the adult. But it allows those people to add those dollars and know that it is a responsible vehicle for growing money for young people.
Does the custodial account have to be tied to a particular person?
It does. And that is, it's always by social security number. And then the sponsoring custodian / parent will be listed as custodian on the behalf of whatever the child is. So you'll have both social security numbers, and when they come of age, the only one that remains is the child, now adult.
Okay. Let's
Okay.
move on to this last account.
Yep. Last one is the HSA, which is the last tax advantaged. Again, it's not retirement necessarily, but it certainly impacts your retirement. And it is an account that is an advantage to you. The dollars are taken out of your paycheck without tax taken. And it's really to offset the new insurance universe that we live in with high deductibles. These health savings account, HSA, is really for any cost you may have that's out of pocket. It can't help you pay your premiums for your insurance, but it can pay for the glasses you might need. It may pay for the emergency room, unexpected visit, medications, those kinds of things that are, again, out of pocket. And again, your tax advantage here is because if you're a tax bracket of 30%, you don't have to pay that 30% before now you get to pay those medical bills. You actually retain your 30% in tax, and now you can pay your bills truly at what you net made from your employer.
All right. Well, we have I'm going to select a couple questions here, and those of you who have questions left, go ahead and put them in the chat. I will make sure to save them and have someone reach out to you after today's event. And I want to thank John for taking some extra time with us to answer these. You never really talked about a rollover per se. Can you tell just high level what a rollover is, even though you kind of covered the concept?
Certainly. I think the most important thing about a rollover is knowing that when it goes from one tax advantaged account, 401k, 403b, whatever that might be, to either the new plan that you work at as an employee, or maybe your own individual IRA, there is no tax consequences rolling one to the other, as long as it's immediately from one to the next. That's the most important thing to understand. You may get documentation, and typically it's the previous employer has to send the IRS notification, hey, we're no longer holding John's money. We don't know where it went. We just know that we're no longer responsible for tracking the taxes. Then when you, part of that process and paperwork, when you roll it, is the signatures that says, I'm rolling it, hey, IRS, I'm rolling it to this other place, right? So don't be looking for it on my taxes. All of that's in the paperwork. It's in the minutia. Just understand that that's part of what you're signing those pieces of paper for, so that the IRS can track where your money is and how it's growing. It's usually a very simple process. And typically, as we mentioned before, if you have a traditional IRA contribution and a Roth contribution in those plans, you're going to have two different accounts wherever you move them to. You cannot commingle traditional money and Roth money, purely for the tax conversation.
All right, and I'm just going to put in one more question here, and then we will ask our attendees. Go ahead and leave your contact information if you would like us to address your question if we haven't had a chance to get to it. So when you work with a financial advisor, what kind of documentation do you need to take if they're going to look at the plans, or what? How can you prepare yourself to talk about the different types of financial plans you might have or want?
Yep, and that's really simple. Typically, a monthly statement or a quarterly statement will give your financial advisor 90% of the information that he or she needs to evaluate not only what you have and what's going on. A paycheck or pay stub, if you're wondering what contribution percentage am I currently giving? Am I giving too much? And is the employer matching that? All of that will show up on your pay stub. And if you were to say, hey, financial advisor, can you tell me if my assets, the mix is right and so on, then you might need the investment lineup, they call it, the list of investments available. For that advisor to say, altogether, I know you as an individual, these are the investments that you have available. I can't make the decisions for you, but I can say that this one's really aggressive and this one's not. And if you want to be, more conservative or more aggressive, then these are some suggestions as to how you can make those adjustments if you feel the percentages are too aggressive for you or what have you. They can't make the choices for you, but they certainly can educate you on what type of investment is there for you to choose and how it will act. And then up to you to say, wow, I do or I don't really like that. Okay, well, then you go back to the website, you make the adjustments for the plan provider, and off you go.
Well, I want to thank all of the participants for their great contributions as far as questions go. Once again, we will be sending you a replay of this event. So look to your email for that. You're welcome to share that with friends or family. And again, we thank John for being so willing to share his knowledge with us. And thank you for the organizations who have brought you this webinar today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.